All right, today in this video, I'm going to show you how to make 39% return on Tesla stock in just 4 days. And I know that sounds crazy, but at the end of this video, I'm going to prove it to you. So let's jump right in. But before we do, this is not financial advice. You can lose money with options and you can lose money with this trade that I'm going to show you. Do your own research and analysis before doing this trade. And also, depending on market conditions like volatility and option liquidity and even the stock price, I might decide not to do this trade next week anyway. So, yeah, those are the things that you have to consider. All right. So, with that out of the way, what is this trade? I call it the twin butterfly on Tesla. What exactly is that? Is this trade? It's a combination of a long call butterfly and a long put butterfly. The long put butterfly, uh, you know, uh, comprises of buying the 385 put, selling two of the 405 put, and buying the 425 put. The price right now of Tesla is around 430, and so the long call butterfly, I am buying the 430 call, selling two of the 450 call, and buying the 470 call. All of them are expiring on February 6th, and the cost per contract, including both the long put butterfly and the long call butterfly, overall the cost is around $815.50 according to Option Strat, right? So visually, this is the representation of the profit versus the price, and you can change this, you can toggle this the expiry, and this is on Thursday around 12:30 p.m. This will be the profit profile, and this is how the two butterflies were set up. That's why I'm calling it the twin butterfly strategy. All right. And why do this trade, or why am I doing this trade? Well, because right now Tesla seems to be range bound, right? It is actually bullish on the weekly chart, which is weird because it's bearish on the daily chart. So it's like a little bit long term, Tesla should go up, but on a daily basis, it can also go down. So that means, guess what? It's range bound, right? It has support at $414 and resistance around 456 and 491. So support means the price will bounce off of that price, and resistance means that the price can, once it hits that price, it can go down from there. And then there are two levels of resistance. All right. Now, based on the long straddle, meaning buying an at the money put and an at the money call, the cost of that is $20.28, or the range of the stock will be around $20, right? That's the expected move. So that means right now the price of Tesla is at 430 plus $20, so Tesla's price can go up to 450, or it can go down to 430 minus $20, or it can go down to 410, right? So which coincidentally kind of coincided with the resistance and support respectively, right? There is resistance at 456. The upper price should be around 450 according to the expected move in 1 week, and the lower price is around 410, and there is support at 414. So this gives me confidence that that Tesla's price can actually go up to 450, or it can go down to 410, right? So, and that's why the twin butterfly strategy works, because if it goes up to 450, you make money. If it goes down to 410, you still make money, right? So, and here, let me show you why Tesla, I believe this coming week will be range bound. On a weekly time frame, right? The stock is bullish, So why do I say that? Because the 10 EMA, the blue one, is above the 20 EMA, and the price right now is actually above the 50 EMA, which I'm not showing it here. This is on a weekly time frame, but on a daily time frame, the stock is actually bearish. So let me move my face out of the way here. On a daily time frame, as you can see here, there was a sell signal because the 20 EMA is above the 10 EMA, and then the price is below the 50 EMA. And right now, the 10 EMA is still below the 20 EMA, right? And the price is still below the 50 MA, so it's not yet bullish. In fact, it is bearish, right? The sell signal has not turned into a buy signal, but on a weekly time frame, it is bullish. So most likely, because of these two contradicting forces, right, the price of Tesla stock should be range bound. So maybe in the short term, it will go up to 450, right? Now, I only do this strategy, way before or way after earnings, right? Or immediately after earnings. And Tesla just had its earnings call, quarterly earnings call or whatever you call it. And so, do not do this trade if it will expire, and then there's an earnings call. Don't do that because earnings is a binary event, right? So it can really mess up the risk profile of a trade like this. So do not do this when you're close to earnings. All right. You can do this after earnings, but definitely not like a few days before earnings. All right. So, now, where's the money in this, right? So my plan is to exit by Thursday, February 5, around 12 noon Eastern, right? That's my exit based on, I guess, the simulation that I did to the option strat, right? So if Tesla's price goes up to 450, I make 42%, $345 on an $816 investment or 815 and 50 cents. So that's pretty good. It's 42%. If Tesla crashes down to 410, I make 39%, $318. So the average of the two is around 40%, right? So if Tesla's price remains the same, that is, it doesn't change from 430, it goes to 425, then it goes down to 430, it goes up to 435, then it goes down to 430. If it's range bound like that, like really tight, then this trade will lose money around 31%, which in this case is $250. Okay? So do not do this trade if you don't if you cannot afford to lose $250. Okay? So the reward to risk ratio, that's why this trade is justified, is because the reward is more than the risk, right? This is, in this case, the reward to risk ratio is 1.3, around 1.3, meaning the reward is 30% higher or 33% higher versus 30% higher versus the risk, right? So I can lose 250, but I can make 345 or $318, right? Let's just round it up to around $325, right? So if you do the math in there, that's around 1.3, and therefore the trade is justified, right? You can take the risk because if you lose, you cut your losses at the 250, but if you win, you let it run, to 345 or even higher, right? So, and also you gotta have a stop loss if in case Tesla skyrocketed above 462. That's kind of like the break even there on the upper bound, and then or it crashes below 392. Okay, that's your lower bound. Okay, so because at those points, then you will start losing money, right? So, okay, so those are your stop losses. So let me break it down, the potential profit, right? So if the price of Tesla goes up to 450, then the profit is 345, as you can see there, profit right here. But if the price of Tesla crashes to 410 right here, then the profit is $318 or 39%. So it's pretty good. And so again, this is by Thursday around 12 noon Eastern. All right. So here's the twin butterfly results a trade that I did a few days ago on MSTR. And with MSTR, based on the simulation that I did on option strat, I have to exit the trade on Tuesday instead of Thursday. Because the risk reward will flip if I wait beyond Tuesday. All right, it becomes less than one. So in this case, the risk reward or the reward to risk is around 1.07. So in this regard, the trade with Tesla, that hopefully that I'll be doing next week is actually better from a reward to risk standpoint versus MicroStrategy. That's why on MicroStrategy I exited a lot sooner versus my plan with Tesla. But as you can see here, the reason why I showed it to you is because I actually exited twice. Okay, so I have two contracts each of the twin butterfly, and in the twin butterfly I have this is the long put butterfly, and this is the long call butterfly. All right. So the long call butterfly, what happened was MicroStrategy went down in price, and so the long put butterfly made money, but the long call butterfly loses money. But overall, right, 219 minus 160, I'm still up 59 bucks, right? So, and then the next day, which is the final day that I have to exit the trade, so I decided to take partial profits because hey, if it's already in profit, why not take partial profits, and you also take the risk of the table because with that specific trade, I placed it on a Friday, but I knew I have to exit by Tuesday. So when it was profitable by Monday, then I decided, you know what, let me take some profits now, but let me keep one other leg in there or one other contract, because what if the price goes the other way, right? But what happened was the price stayed lower, than, and that's why the long put butterfly, remained more profitable, and it went up $293. But the losses, or I mean, I guess the loss on the long call butterfly also increased, right? But the net result, I am up, what's this, $85, right? So that's the goal is, one of the butterflies, because it's a twin butterfly, one of the butterflies will be a losing trade, but the winning trade will more than offset the losses on the losing trade. That's the goal, right? And you want the price to go either up or down, right? And the ideal situation is, let's say the price of Tesla goes down, then the long put butterfly makes money, and then you have mean reversion. It went all the way up to 450, from, let's say, from 410 it went up to 450. Then the long call butterfly, made makes money, right? So you exit the trade when it's already profitable, if you can, right? You don't have to wait until Thursday. In fact, you're minimizing the risk, when you're doing that, right? Because remember, this trade will lose money if the price of Tesla remains around 430, which is the price right now, right? So if it's between 425 to 435, averaging around 430, then you're going to lose money. But knowing Tesla, how volatile it has a 44% volatility. I mean, it should, really vary in price. So most likely, again, based on the expected move plus, support and resistance, it should be range bound between 410 to 450. So, the hope is Tesla's price goes up from 430 to 450, then we make money there, and then, then it mean reverts, but it goes all the way to the downside, right? To 410, or it can remain there at 450. Then, then you will still make money, right? But what you don't want is for Tesla to be stuck in the middle, and also you don't want Tesla's price to skyrocket, right? So for example, it can go from 430 to 500. You don't want that, or you don't want the price of Tesla to go from 430 to, let's say, 300, right? Like you don't want a big crash, and you don't want a the price to skyrocket, right? Because what you will see there is, instead of one of the option trade, one of the butterflies being profitable, then, if the price skyrockets, then both butterflies becomes negative, right? Or if the price crashes, then both butterflies will be negative, as well. So what you want is one of the butterflies will be way ahead of the other butterfly. So even if the other butterfly loses, the overall profit on the butterfly that wins more than compensates for the loss of the butterfly that loses. Okay? So, and in the case of MicroStrategy, I made 10.24% return, which is not bad in basically 1 to 2 trading days, right? So see here, I opened this on a Friday. I exited, one of the contracts on a Monday, and I exited the other contract on a Tuesday. All right. So here will be your stop losses at 427.58. You'll have $252. That's your max loss in there. Also, if the price crashes down to 387.62, or if the price shoots up to 467.16, then you will lose money, right? So you want Tesla to be range bound and based on the expected move, which by the way, the way this is set up is that the price of Tesla stock can actually go beyond the expected move, right? So there's still some buffer on the upside and there's still some buffer on the downside. And considering the reward to risk is 1.3, that's why I am doing the trade, right? Barring any black swan events in which the price of Tesla, like really crashes down, volatility is very high, and then maybe it will trend going down, then I don't want to do the trade, right? So let's see on Monday what happens. Okay, so for how do you place this trade, I'm going to show you how to do that in Robinhood. But in Robinhood, what you do for the long call butterfly is you buy the 430 call, right? You sell the 450 call, then you buy the 470 call, and what you do is you edit the ratio. Okay, don't click continue yet. Edit the ratio and then change this number, the 450 that you're selling, into 2 because you need to sell 2 um, call options in the middle of a lower lower price call or lower strike price call and an up and a higher strike price call, right? So you buy calls, the 2 calls in between, the 450 call, which you sell, and you sell 2 of those. That's your butterfly, right? So in the risk profile, you should see a P&L profile like this, right? On the other hand, how do you do the long put butterfly? Well, you buy the 425 put, then you sell the 405 put, then you buy the 385 put, you edit the ratio, you change this to 2, and again, you will have a profile that looks like this. So it should cost you 381, if you're doing just one of them. And then the long call butterfly should cost you 435, so the total cost is around 815, 816, right? So, and what I'm going to do is I will place the trade 9:30 a.m. Eastern on that Monday. Why? Because I want to take advantage of the volatility. Because what happens with the two butterflies, the long call butterfly and the long put butterfly, uh, in periods of high volatility, right? What ends up happening is the long call or the long put that you sell, right? It has higher premium and therefore your cost will actually go down, right? And also, what you want is to start this at higher volatility because this becomes better when the volatility goes down, okay? In fact, here's the risk. Here's the other risk, in addition to the price of the stock, either staying in the middle or skyrocketing or crashing hard. One of the risks is volatility, right? Because if the volatility increases, what happens to the profit curve, so remember, I increase the volatility here in the option strat, basically like simulator, right? I increase the volatility from 44 to 59%, almost like a 50% increase in volatility, which can happen when the price crashes hard, for example, or when the price skyrockets, for example, or there's a lot of there's a lot of trading. It's like moving like really wildly, right? Then you have higher volatility, and when that happens, the profit curve becomes flatter, right? So it goes down, right? So instead of making 300, $300, you might make only $200, right? And what happens to your profit range? It gets more squeezed, right? So if the price of the stock really crashes down, then you will get to the max loss sooner, right? Or if it skyrockets up, you will get to the max loss sooner, right? Versus the volatility is lower, right? That's why you placed it when the volatility is high so that when you exit by around 12 noon, right, the next day or on Thursday, usually the volatility dies down after, there's high volatility between 9:30 to 10 a.m., like the start of the market, right? Usually, so that you place it at that point when the volatility is high, and then you exit at around 12 o'clock or maybe even like after 1 p.m. when the volatility died down in order to maximize your profit and minimize the risk of your profit curve being flatter and narrower, as a result of higher volatility. Okay, so And then for some of you who are more, you want to make even higher profit, right? So just like what I did on MicroStrategy, where I actually placed two contracts, right, instead of just one, right? I will do the same thing. And if the trade is profitable, maybe even on a Wednesday, to be honest, right? But definitely, if it's profitable on a Thursday, I'll exit potentially just one of them, right? And then if the price is way above, right, the middle zone, right? In this case, between 416.84 to 438.14, let's say it's on like close to 460, and the likelihood of the price going back down, right, is likely low, although of course there's always a possibility that that can happen. What I can do is I can keep the other contract, right, and keep it and then exit on a Friday, also around 12 noon or maybe around 1 p.m., right? So that by doing that, actually the curve, right, the profit curve actually rises as time goes on. Okay? So as you can see there, it goes from, 32% profit to now basically 100% profit, 100% return, right? But again, the risk is what if the price goes up, let's say to 450 or even 460, but then the next day, Friday, it crashes down back to 430, then you are in the 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 middle. You can lose money there, which is around 88% or $717. But I am thinking like, hey, if I already made money on Thursday, then I would have pocketed around $300 anyway. And if the price goes down back to like, the middle the next day, so that's a $700 loss, you know, then, you know, then I would have lost $400 for two contracts. I was willing to lose $500 anyway because remember the loss per contract is 250. That's the loss that I can that's the stop loss that I have, right? So times 2, the stop loss is $500. So since I'm willing to lose $500, and if I do it in such a way that I already pocketed $300 on Thursday, and if I lose $700 on Friday, then my net loss is $400. That's still below, my $500 stop loss, right? Because the consequence of doing that, if I'm right, if the price doesn't go down back to the middle, is that I'll make an additional $800 on the upside, right? So now, I can make $1,100 or even $1,200, right? By doing it that way, having two contracts, right? And the risk is actually $400. So in a way, I kind of improve my reward to risk ratio. 1,200 divided by 400, right? So that's a 3 is to 1 now if I do it that way. Okay, so that's why for me, I can take on the risk. But again, do not do this trade if you cannot afford to lose $700. Okay, so do not do this trade, right? But if you can, and if the reward to risk for you is tolerable, right? You have a higher risk tolerance, then definitely do this trade. I'm definitely doing this trade in both my small account, which is less than $4,000, and in my regular account, which is around $32,000 now. At least that's the value even after the drawdown that happened yesterday. So I will likely just do one contract with a smaller account, and then I'll have two contracts in the bigger account. So those two accounts are part of my US Investing Championship. That I'm participating in the 2026 US Investing Championship using those two accounts. And I'd like to show to people that hey, even with a small account, you can grow that. Or if you have like at least 30,000, you can also grow that. And hopefully, I will make about 100% return in the next 12 months. I'm kind of on track in doing that because I'm around like close to 8% even after the drawdown that happened yesterday. So yeah, so that's what I'm going to do on Monday, doing the twin butterfly trade, so that because again the reward to risk is makes it worthwhile, right? So if you want to learn more about stock options and you want to follow my US investing journey, definitely subscribe to this YouTube channel and like this video. And if you're thinking of doing options and you've seen a lot of gurus talk about covered calls. Here's the thing, do not do covered calls until you watch this next video, because I've done all the back test so that you don't have to, and what I found is kind of disappointing. Okay, so watch this video first before you do a covered call, and you will thank me later, and I'll see you there in that video.